Hey, welcome back. As mortgage rates have been on the rise, more people are deciding to take on a more risky loan product to buy houses right now. I'll discuss that in today's video, plus some early indications of home buying demand regarding purchase applications, mortgage rates, real estate showings, and much, much more. If you guys get any value out of today's video, then of course, please hit the like button. Also, consider subscribing as well. I post frequent housing market updates so you guys can be more informed. I actually love making these videos. I'm just an analytical person, so I love making these videos. In any case, the first report I want to discuss is this right here. This is from the MBA, just posted on May 1st, which is today. This covers the week ended April 26. This is a report I cover each and every week regarding the amount of people who are submitting loan applications to buy houses. On a national level, that decreased by 2% from 1 week ago, but it's down 14% on a year-over-year basis. So here's a look at the MBA's purchase index. Just kind of think of it this way. A high number means that more people are submitting loan applications to buy houses, and of course, a low number means just the opposite. So for the past month or so, the level of purchase applications has been relatively flat, which is ironic given the fact we're basically in the spring home buying season, right? But also applications have decreased now for 2 consecutive weeks. That's over the previous 1 year. Look at the past 5 years though. You can really see this big decrease of applications overall in the US. They peaked around when was this? The end of January and the beginning of February of 2021. Back then, the index was at 334. Now it's at 141. So the level of applications right now is actually less than half compared to more or less early 2021. Also going back to the early 1990s, you can see the surge of applications that we saw back in 2004 and 2005. The index back then, 490. Now it's had only 141. So a huge decrease of applications really ever since 2021 and the early parts of 2022. And this is very much an early indication of home buying demand because, of course, we see a lack of applications. And this implies we'll see a low level of closed home sales in the coming months as well. Let's get back to the MBA's report. According to their senior vice president and chief economist, Mike, he said the following: inflation remains stubbornly high, and this trend is convincing markets that rates, including mortgage rates, are going to stay higher for longer. We've been talking about that for quite some time, right? The Fed is not going to decrease rates anytime soon, and because of that, we're going to see this environment where we have high rates for a long period of time. No doubt, this is a headwind for the housing and mortgage markets, with a 30-year fixed rate increasing to 7.29% last week, the highest levels since November of 2023. Let's talk about rates really quickly. As of May 1st, this is according to Investopedia.com, the average 30-year fix for people with great credit, 7.36%. The Mortgage News Daily at 7.41%. That is a 10 basis point decrease compared to yesterday, which was on Tuesday. If you're looking at an FHA or a VA loan, you're going to be around 6.9%. Also, 1 year ago, not that, 1 year ago, which is right here, the average 30-year fixed rate was at 6.73%. So rates have increased by approximately 68 basis points compared to 12 months ago. Going back to the MBA's report, it says application volume for purchases and refis decreased over the week and remained well below last year's pace. Again, down by 14% for purchase applications, and refis actually decreased by 1% from 1 year ago. One notable trend that I mentioned at the very beginning of this video is that the ARM share of activity, in other words, an adjustable rate mortgage in which you have a teaser rate in which your rate is fixed for a short period of time, then your rate becomes variable thereafter, that has reached its highest level for a year at 7.8%. So out of all the applications for mortgages, 7.8% is a share of adjustable rate mortgages. Prospective homebuyers are looking for ways to improve affordability, and switching to an ARM is one means of doing that, yet a risky loan product in my opinion. With ARM rates in the mid 6% range for loans, with an initial period of about 5 years. Let's talk really briefly about this because the average 30-year fixed rate, according to the MBA, is at, where was it at? Right here, increased to 7.29%. Looking at a 5-1 arm, in other words, the rate is fixed for 5 years, then it becomes variable thereafter, and the rate adjusts every year thereafter, is at 6.60%, quite a bit less than the 7.29% for an average 30-year fix. So let me give you guys an example regarding why people would decide to go to an ARM versus a 30 or a 15-year fix. So let's just say someone's buying a $500,000 home, putting 5% down. Your loan amount would be $475,000. At the 7.29% 30-year fixed rate, your housing payment would be $3,253 per month. I'm excluding taxes, insurance, and HOA. I only want to look at the difference between a rate at 7.29% compared to 6.6. So at 6.6%, you're looking at a housing payment at $3,033 per month. That's approximately $200 less than an average 30-year fixed rate mortgage. So because we have this giant housing affordability issue right now, we're seeing interest rates overall increasing and very close to about a 5-month high at around 7.4%. This means that more people are deciding to do a 5-1 arm or a 7-1 arm, an adjustable rate mortgage, in order to have a lower housing payment. And again, in my opinion, this is a much risky loan product because your principal and interest payment is only fixed for that teaser rate and then it adjusts thereafter. Much different compared to a 30-year fixed rate in which your principal and interest payments is fixed over the life of that loan. All right, let's change gears slightly here and talk about the amount of real estate showings across North America. This is according to showingtime.com. The most recent data that we have from them is through April 30th. The week ended April 30th. This year, real estate showings compared to the first week this year are up by 31.5%. At this time last year, we saw an increase of 27.4% compared to the first week last year. And in 2022, we were up by 20%. 2021 up by 44.5% compared to the first week that year. So the 31.5% gain we're seeing year to date so far this year is the highest percentage increase since 2021. Also, let's have a look at the number of people who are searching for homes for sale on Google. The interest over time right now, the index I should say, is at 70. 1 year ago, we were at 90. This means that there's approximately 22% less interest for people searching for homes for sale on Google right now. And lastly, let's have a look at the CME watch tool. This is the likelihood of changes to the federal funds rate by the Fed. The Fed actually was announced today, which is on May 1st, that they kept the federal funds rate at 5.5%. The next meeting, which is on June 12th, again, a high likelihood, a 91% probability, they're going to keep rates the same at 5.5%. We're seeing exactly the same in July 31st. Then in September, a 46.2% chance we're going to be at the same rates again at 5.5%. This rate, by the way, is the federal funds rate, which is the rate that the Fed changes. And this is the overnight rate that banks charge each other due to overnight lending. When the Fed increases or decreases the federal funds rate, that does impact mortgage rates though. That's why I want to talk about this in today's video. When looking at September 18th though, there is a 42.6% chance they're going to decrease rates by 25 basis points down to 5.25%. Then in November, a 43.7% chance we're also going to be at 5.25%. Again, a 25 basis point rate decrease compared to the 5.5% rate we're seeing today. Then by the end of the year, this is where it gets interesting. And of course, this is going to change, and it does change virtually every single day based on incoming data. But something I found to be really interesting though, is that the street, this forecast, is basically calling only for one rate decrease this year. So by the end of the year at 5.25%, that is a 39% chance we're going to be at the same rates, or about a 25 basis point rate decrease compared to the rates we're seeing today. Going back to about 6 months, the overall forecast was the Fed was going to decrease rates by about 4 times, by about 1 full percentage point this year. And they were calling for the Fed to decrease rates starting in March this year. And now we're in May and no rate decreases in the foreseeable near future. So very big changes here. Now, something else that caught my attention as well. Again, right now we're at 5.5%. This is something new. There's a 19.3% chance we're going to be at the same rates we're seeing today by the end of the year. So we could be in a scenario in which we don't get any rate cuts whatsoever this year because there is a 19% chance right now, based on the data we have right now, that we're going to be at the same rates that we have today by year end. Now, this is vastly different compared to just 1 month ago. 1 month ago, the chance of that, only 2%. Now it's at 19%. I think we all can agree we're going to be in a higher for rate environment in which rates are going to be higher for a longer period than what was previously expected. And of course, that could take the wind out of the sails during this spring home buying season. And we're going to see this higher rate environment for home buyers as well. And that will likely impact or negatively impact home sales in 2024. And with that said, if you guys got any value out of today's video, then please hit the like button. I would appreciate that. Of course, I appreciate you. Also, consider subscribing as well. Also, if you guys want a real estate agent referral, whether you're looking to buy or sell a house anywhere across the United States, then check out my website, which is realestateteamfinder.com. Hope you guys have an awesome day and look forward to seeing you on the next video.